Thank you, Jerome Powell. You just crashed the stock market. Now what are we supposed to do? I'm not really that worried about it. I'm a long-term investor and I actually want stocks to go lower because I'm going to be adding to my portfolio for the years to come. There are always risks of crazy market crashes and depressions and stuff like that. But that stuff is not the norm. Markets have good days, they have bad days. They go up and they go down. This is all normal. I'm not concerned with the stock market drop. And the first reason why is that I only invest money that I don't need for at least the next 3 years. And the money I do have invested is designed to be a long-term investment, 5, 10, 15, 20 years. When you have that mindset, these daily drops start to look like opportunities, not like crazy fear-driven panic attacks. What I want to talk about in this video is what Powell said that I think made the market react this way, which wasn't surprising. And then 3 stocks that I'm focused on learning more about and buying more shares of because I think they're very strong companies and they're going to make it through this downturn and come out stronger. And I'll be happy in a few years that I was buying today. That's how I feel. All right, so we see it. The Dow was down 1,000 points. The S&P 500 was down 141 points. That's 3%. S&P was down 3.3%. The NASDAQ was down almost 4%, 497 points. And the Russell 2000 was down 63 points for 3.2%. All right, so Powell warned of some pain ahead as the Fed fights to bring down inflation. Jerome Powell on Friday pledged that the central bank will use our tools forcefully to attack inflation that is still running near its highest level in more than 40 years. That line right there was pretty much what scared people. We will use our tools forcefully. People were thinking that the Fed might turn around and stop or slow down hiking interest rates. He has not indicated that that's the plan. In his annual Jackson Hole, Wyoming policy speech, Powell added that higher interest rates likely will persist for some time. Historical record cautions strongly against prematurely loosening policy. The remarks come amid signs that inflation may have peaked but is not showing any marked signs of decline. Powell said the Fed will not be swayed by a month or two of data. All right, that's where it's at. That's what's going on with the Fed. I really don't pay a lot of attention to this macro stuff. I am focused on companies and owning them for the long term. And I want to show you literally what I've been doing in the portfolio, okay? This was a Tesla split. I got 15 more shares. Cool. On the 24th, I bought 1,500. I deposited money on the 24th. On the 10th, I bought 2,200. Deposited money there. I bought on August 3rd, $2,200. Deposited money that day. In the afternoon on the 27th, I bought $8,500. That was Meta right there. On July 20th, I bought. That's all you see. This is a long-term portfolio. The goal is to build this thing up to $1 million, and this is how we're doing. So we're at $92,478. We've put in $88,400, so we're up a total of $4,000, okay? This started on February 15th, 2022. Over the last week, we're up $2,000, up 2%, okay? Even with as bad as today was, and then if you look at today, I'm actually kind of surprised that the market was down as bad as it was, but my portfolio, which is all in growth stocks, was only down $2,800 or 3%, actually less than all of the major indexes. Kind of crazy. So what happened? Let's see. Well, Snowflake was up. Gitlab was barely down. Tesla is down almost 3%, but still less than the market. MongoDB was down less than the market. Datadog was down a little bit more. Okay, and then the worst performers today, the Trade Desk down 4%, Mercado Libre down 4.5%, and Cloudflare down 5.6%. All right, so that's what happened. Let's get into the 3 stocks that I think are good buying opportunities that I have bought recently, and I plan to continue buying as more money comes into the portfolio if the market stays down like this. Meta, just talked about it, just showed you, bought it right here, right? And so with Meta, I mean, if we look at the performance of this company long term, it is still, even with the bad years that it's had over the last 10 years, it's up 15.5% on average, turning a $10,000 investment into a $54,000 investment when you factor in the initial investment and the growth in the dividends, which there haven't been any. Beating the S&P 500, which only turns that into $46,000. So beating it by about $8,000 overall, okay? So they're still winning even after this crazy drop. But if we look at Meta, It's right now trading at a PE of 15. It is almost, this is like the lowest PE that it has traded at almost ever. It might be its lowest PE ever. Okay, and so sure, there's not as much growth ahead for Meta, but I wrote about this in my email newsletter, which you can check out, austin.substack.com. I'll link it down below. I've done videos on Meta. I think the investments they're making into Reality Labs and Oculus, I don't think Facebook is dying. I don't think Meta is dying. I think they're adapting and they're investing for the future, and they're making a big bet on the metaverse, which if you've heard Mark Zuckerberg talk about it, he was on 3 pretty good podcasts. He was on Lex Fridman, he was on Joe Rogan, he was on another podcast that I can't think of right now, but very insightful, Tim Ferriss. Very insightful podcasts that help you see what his vision for this thing is. And the thing that you'll see with Facebook under the hood is that they have the balance sheet, they have the margins, they have the user base to really invest in making this transition to the metaverse, and really no one else can invest those type of resources into making this kind of pivot. And so I think in a number of years, it's really going to pay off. It's just, can you be patient and wait? And there's a risk, of course, that they're wrong. Okay. But even if so this is showing the average price to earnings ratio in the blue has been 34.9 since 2011. All right. Let's shorten that up though. That's not realistic to think we're going to get back there. If we just go over really since 2017, the average PE ratio is down to 26. Okay. That's with a 11% earnings growth rate. All right. Well, for this year, they're expected to actually drop earnings 28%. But then getting back to 2023 and 2024, they're actually expected to get back to 13 to 17% earnings growth, right in line with the average over the past 5 years, right? And so then why wouldn't it trade back up to its normalized PE ratio during that time, or even a little bit below that, okay? So from here, from a PE of 15, if they get back up to 26, you're looking at a 35.8% return to December 31st, 2024. 35.8% annualized return for a total return of 100%. So if you look at this number, this is 100% total return, 35% annualized. That would be awesome annual returns. Even if they stay at 15, if they stay at a PE of 15, doesn't go up at all, you're still looking at a 6.3% annualized rate of return. And so with Meta, I think that it's been de-risked a lot. I don't think it's going much lower than a PE of 15. And as long as they don't drastically miss earnings, which expectations are low, I think they're too conservative at this point, then we have some serious upside and a good risk reward in the stock, especially if we want to build up a position for the long term when they do beat that hurdle and the metaverse really starts paying off, okay? So Meta is definitely one that I've bought and am paying attention to. If we jump over to Morningstar, Morningstar has it listed as 51% undervalued. This is, they have the fair value at 346, which I think is actually, it's not that high. It should be lower. But it's 51% below the posted fair value they have. So even if they bring that down 10, 20%, still significant upside. They give it a wide moat and exemplary capital allocation. All right, Mercado Libre. I bought this one this week. Wrote about it in the email newsletter. So again, down in the description if you want to check it out. Got to look at Mercado Libre on a price to sales basis. If you go back to 2006, 2007, on average, they've grown sales at 36.6% per share. That's revenue per share. And they've had a normalized price sales ratio of 11. Well, right now it's at 5, okay? Half of their normalized price sales ratio. If we bring it into just since 2017, their sales growth rate has been 42%, okay? So let's go to forecasting right now, where we can see kind of what analysts are expecting for this thing. Okay, we're going to put analyst expectations in, estimates. They have it growing at 46% this year, 27% next year, and 25% the next year. So even if we think that's going to drop down, we'll just go 15%, a pretty significant drop off the year after that. And we'll do 15% out to 2027. And again, remember their normal price sales ratio, the average has been 11. But if we bring this down just to 5, right? It's at 4.99. It's at 5 right now. Okay. So if it drops down from here, down from 4.99 down to 4 through 2024, that's another 20% drop in price to sales multiple. You're still looking at a 16% annualized rate of return for a total rate of return of 43% through 2024. Okay, if it happens to go up to 5, you're looking at a 28% annualized return, and 5 would not be ridiculous for a company that's growing this fast with as proven of a track record as Mercado Libre. They do e-commerce in Latin America and a lot of other things. They do payments. They have an advertising business. They have a lot of stuff going on, okay? So there's certainly some risks there. But this isn't a joke of a stock, right? Like if you go back to the last 15 years, 2007, the stock is up compound annual growth rate of 26%. It is outperforming Amazon over the last 10 years, all right? This is a very, very strong outperformer over a long period of time. If you have the patience and you can deal with the volatility, there's a lot of potential upside. So if we go out to 27 and they're at a price sales of 5.66, you know, whatever, 5.66, you know, just to give us a basis. That's a 23% annualized rate of return out through 2007 for a 207% total return. I'm happy with that. I'm happy to own this stock. I think it's been de-risked, okay? And Morningstar agrees. It's a 4-star rated stock. They have it at 34% discount to fair value of $1,400. So even if that fair value comes down 10, 20%, you're still looking at it trading at a discount to Morningstar's fair value. They give it a wide economic moat because it's hard to go in there in Latin America and disrupt them after the logistics network and everything that they've built. And they give them exemplary capital allocation. All right, last one, Airbnb. I bought this recently in the portfolio, okay? And Airbnb is trading at a blended price sales ratio of 10 with expected 25% revenue growth next year, 15% the next year, and 20% the year after that, okay? We're not going to use normalized price sales ratio because it hasn't been public long enough. But again, if we go to forecasting and we go to custom and we look at the analyst estimates, analysts are expecting 19% in 2024. So let's bring it down to 15. We're trying to be conservative here. And let's bring the price sales ratio. We'll go around 5 and just see what it looks like, right? I think they've got pretty high gross margins, so I think it should actually be higher than 5, but we'll use kind of 5 as like a bear case scenario, which is a 50% reduction in price sales multiple from here. So out to 2027, if we're long-term investors, I know it's not fun to think about this if we're thinking about today and tomorrow, but as long-term investors, 5 years is really not that long. Even if they go down to a 5 price sales ratio, and these are, in my opinion, are conservative revenue growth estimates when you consider the size of pretty much the hotel industry and all the growth, and they can move into new industries using the same platform, right? Maybe they do, who knows, car rentals, airplane. I mean, there's so many things that they can use their AI and their platform to do and grow into in the future. Different types of events, not just hotels, right? So they're also buying back shares, and I like the management team. I think, again, this is a great time to buy. But anyways, just on a valuation basis, if it drops from a 10 price sales down to 5 with, in my opinion, conservative growth estimates, you're still actually looking at a positive return over the next 5 years. Okay, so what if it drops down from 10 to 7? Well, now you're actually looking at, with still a reduction in price to sales multiple, you're still looking at an 8.3% annualized return in a company that is still relatively early in its life cycle, okay? If they happen to stay at 10, which I think is probably unlikely, then you're looking at a 16.5% annualized rate of return for 126% total return through 2027. Morningstar, and they actually have it within range we consider fairly valued. So their demand is moderating from high levels, but market share leadership is intact. Okay, so they think they're actually taking market share from other kind of hotel and travel websites. All right, so there you have it, the 3 stocks. Do me a favor if you like this video, if it was valuable to you, like it and subscribe to the channel, hit the notification bell so you never miss an update, and share it with a friend. Thanks.